This week, Federal Reserve Chair Janet Yellen expected to be grilled Wednesday on Capitol Hill over the Fed, standing firm on not raising the benchmark interest rate, which is around zero. This as there is a split within her ranks on taking action now. Critics, including, by the way, Donald Trump, accusing Yellen of playing politics. Jeffrey Lacker is with me right now. He is the president of the Federal Reserve Bank of Richmond. Good to see you, sir. Thanks so much for joining us.
Good to be here, Maria.
So this whole debate about how strong or weak the economy is continues. You've been seeing strength in this economy for a while, and you've been dissenting and telling your colleagues at the Fed we need to raise interest rates. Is that right?
It is. I thought the case was strong this past week for another increase. Given how tight labor markets are, given how close we are to our inflation target, our benchmarks point to interest rates that are substantially higher than they are now, and I think we need to get on with it.
What are they seeing that you're obviously not seeing? I mean, why has it been so difficult to raise interest rates? We know that savers are being punished. They have money in their savings accounts. They're not getting any yield on it.
We've seen really strong employment growth from the beginning of this recovery in 2010. And it looks as if labor markets are fairly tight right now. There's a lot of widespread reports of firms that are having trouble finding skilled workers. There's clear evidence of wage pressures. Wage rates are accelerating. They're picking up pace. It's not uniform. To be sure, there are individuals whose experiences are very different because there's been a profound change in this economy. There's been a real shift in the skills that businesses demand. So some people's experience isn't great, but on the whole, and that's how we have to judge monetary policy, labor markets are fairly tight. And when they get tight, interest rates need to rise to keep imbalances from arising. Now, in fairness to my other colleagues, the other point of view is that we need to explore and find out whether there's a chance that we can make labor markets even tighter without sparking inflation. I think the evidence on that is mixed, and I'm troubled by where we are right now.
So let's talk about where the strength is, where the growth is. We're all looking for growth in this country, right? And where the weak spots still remain. Because I know that the business segments, businesses are sitting on cash. They are unwilling to, put new money to work. They've got all this money overseas. Is that a regulatory issue? Is that a demand issue? How do you see this inability of business to invest in CapEx?
That's a really good question. Capital expenditures, investment in new plant and equipment and intellectual property intangibles has been relatively soft and stagnant for the last couple of years. Part of that is what's going on in the oil and gas sector with the fall off in drilling activity, but that's bottomed out. And there's a broader weakness. Some of it is perhaps related a little bit to the strength of the dollar and a lack of export demand, but that doesn't seem to be all of it either. There's something broader going on. This is important because capital expenditures are what lead to productivity growth, growth in the output per worker that we see in our economy. And ultimately, real incomes for Americans are tied closely. They track closely with productivity growth. There are a couple of theories about why productivity growth is low. One is that we measure it poorly. There's something to that, but that doesn't seem to explain it all. Another theory is that we've run out of good ideas. That seems implausible to me, but it could be. Another theory is that the wave of regulatory things that have come along in the last couple of years, last decade or so, are swamping American businesses, discouraging business formation and discouraging investment. I think I give that some credence too, but we don't have the ability to quantify these and really sort them out right now.
Well,
so
there is a pushback.
There's some uncertainty about it.
I'm sorry. There is a pushback because of Dodd-Frank, because of Obamacare, because of EPA regulations. The businesses are feeling that they don't know what's around the corner in terms of regulation. So why would I go invest in this now? Let me wait to see what's happening. Now, you just made an important point that I think viewers really care about, and that is, are you out of ideas? I mean, you look at what's going on internationally. You've got these international central banks going to negative interest rates. People are saying there's not much more a central bank can do. Is there?
I think we got more credit when the economy was going really well in the 90s than we deserved.
Right.
Our job was to keep inflation low and stable. We did a good job of that in the 90s, but the tech boom wasn't our responsibility. We didn't bring that about. Similarly, I think we get more blame for a sluggish recovery than we deserve. There really isn't anything monetary policy can do about the rate of productivity growth, the rate of capital formation that goes into that. And so we're doing the best we can. We're keeping inflation low and stable. I think we've done a good job since the recession ended, and people need to realize that there's a range of policy out there. We're responsible for a narrow slice of economic policy, just what affects the inflation rate.
Frankly, I think the Fed has done an excellent job, given the fact that you've had nobody else doing anything. A lot of people are talking about the fact that we need fiscal change, like tax reform. How important would tax reform be to help you guys along and help you with your job in terms of lifting this economy? Over
time, any tax code accumulates some perversities and incentives that dampen productivity growth. Ours is no exception. From time to time, it's great to clean that out and realign the tax code with incentives to make the productivity and income enhancing investments that our economy needs.
So you voted this last week to raise interest rates.
Well, I didn't have a vote. So as you may know, 12 reserve banks, 5 vote at a time. So I'm not voting this year. Last year I voted.
Will you vote next year?
No. 2018 is when I'm supposed to vote.
When you look at what went on last week in terms of the debate, or 2 weeks ago, in terms of the debate around the Federal Reserve raising interest rates in September, 2 months rather, before the election, would it have been political if the Fed raised rates in September?
I don't think so. We're an apolitical institution.
Exactly.
We judge things on the merits, what's needed for the economy, and we haven't let elections dissuade us in the past. We'll do what's needed for America.
So it's not one of the reasons?
No.
What about the governance of the Federal Reserve? A lot of outsiders now looking in saying, look, we need to change the way the Fed is governed. We need to make sure that there is 100% independence. Even if you are independent and the Federal Reserve is independent, that hasn't stopped people from talking about new proposals to change governance.
We've been in the spotlight since the crisis. We took a lot of unexpected action, so I'm not surprised by the scrutiny. There have been a number of proposals to change our governance structure. In a minute, just to explain what it is, there are 12 independent reserve banks. We are separate corporations. There's an agency in Washington, the Board of Governors. That's a board, consists of 7 members. They're appointed by the president, confirmed by the Senate. The reserve banks are independent of that, and together both of us participate on the FOMC. So this structure achieves a number of really important goals. It keeps us engaged in our district. The reserve banks spend a lot of time understanding what's going on at a grassroots level in our economy. It assures a diversity of views are brought to the table. The reserve banks do the independent analysis and bring those views to the table. And you saw that last week with 3 dissents. And in addition, it assures that we're as apolitical as possible. They were trying to achieve a fine balance. So a central bank, a Federal Reserve that was closely aligned with one political party or another would not be good. We've had instances in the past where monetary policy run for the benefit of one political party gooses the economy but leaves the costs for policymakers down the road. And that's a bad way to run policy. I think everyone agrees. And
it's important to get the knowledge of each of the districts in terms of what you're seeing, who you're speaking with. I mean, what would you say is most important in terms of the value that is being brought to bear from the districts? Because you're getting all different looks. I mean, San Francisco is going to say something very different, for example, than Midwest would say.
Absolutely. We make policy on the basis of what's going on for the nation as a whole, but our grassroots understanding of what people are saying, consumers, businesses, nonprofits, about what's going on in their world is very timely, very important, very insightful for us. But that political balance, that ballast, that, if you will, the apolitical nature of the system is really essential too.
Is it likely we'll see a rate hike in December?
I think the case is going to be strong based on what I see now, but there's some more data to come in between now and then, so we'll see.
Mr. Lacker, good to see you.
Thank you.
Thank you so much for joining us. Jeffrey Lacker is the president of the Richmond Federal Reserve.